Hey, hello everybody. This is Ronald Poon from Ronald Poon Real Estate Group, and today I have a very interesting topic to talk about. This is if RRSP is actually beneficial, and we're going to go through some examples today. And just a spoiler alert, it is always beneficial to put money in your RRSP, and let me explain why. So let's first take a look at assuming you're from Ontario. I'm an Ontario-based realtor, and also this video is tax tips, but I'm not a tax accountant, so disclaimer, you have to contact your accountant. Okay, so in your RSP, when you take money out, it counts as income at your current tax bracket, and we're going to assume that you're going to be taking out the RSP when you don't have any more income. So it's going to be at 20% around, while if you were to sell your stocks at your lowest tax bracket over time in chunks of $26,000 capital gains, you can get taxed 10%. So let's take a look at some examples here. So let's assume you're making $90,000 income, okay? And the tax bracket of $90,000 is around 33%. And you currently have $10,000 in your RSP contribution room. So this $10,000 is, if you contribute to your RSP, is tax-free. So now you don't have to pay the 33%. So that means it's $10,000 in 7 years. Let's say stocks can double in 7 years, is going to be $20,000. But what is the cash that you have left after you take it out? So this $20,000, you're gonna be taxed at the full 20%, and this is if you are disciplined enough to withdraw it at the lowest tax bracket. And this is assuming when you are unemployed, when you're really old, and you can take out $20,000 a year at 20%. So at the end of 7 years, let's just say you retire in 7 years for simplicity's sake, you'll have $16,000. So I'm going to use another example now of not contributing to RSP. So $90,000 income, and let's say $80,000 is used for your living expense, right? So this $10,000, if you don't use your RSP, you're going to be taxed at 33%. Because we are assuming that you are at this higher tax bracket area where it's around 33%. So instead of having $10,000 to invest, you now have only $6,666 to invest. If it doubles in 7 years, you only have $13,000 instead of $20,000. However, when you take this money out, since when you got the income, it was already taxed, you are only taxed at the capital gains, okay? And 10%, we're going to assume you're going to be smart and sell it in chunks of $46,000 or whatever the lowest tax bracket is at the time. Probably it will be higher because of inflation. And then let me tell you how I calculated the capital gains tax. So it's current market value minus the adjusted cost basis. So it costs you $666. And this ACB, a cost adjusted basis. Adjusted cost basis, 13,000. I'm just doing it on my calculator here. So it's, doubled. Yeah, okay. So it's easy. So this 6,666 taxed at 10% equals $666 in tax. So this 13,332 minus 6,666 equals 12,665. So after 7 years, if you don't contribute to your RSP, assuming you're in this bracket and assuming stocks double, these are very reasonable assumptions, you will have 12.665 left over. So the difference is actually a bit more than $3,000. So here's proof that, RSP is beneficial at least this tax bracket. And also, if you, yeah, just at the end of the day, you have more money, so do it. Don't invest in your, this is assuming, by the way, this is assuming your tax-free saving account is maxed out. So you're going to be investing this money at, in what's called a registered account, which means you pay capital gains on your capital gains tax on your capital gains. So now I'm just going to take another look at another example. This is the exact same thing as above, except assuming you retire in 14 years, which give time for the stocks to triple. Okay, let me just prove something to you. How long does it take stocks to double? Rule of 72. Okay, so money double every 7 years around. Okay, I'm not making this up. So I'm not going to go through all these calculations again, but basically, if you use RSP to invest that, assuming you use 80,000 as your living expense and 10,000 as investment, and then you invest it triples, you have $24,000 left over after paying income tax on $30,000 at the lowest tax bracket. This is you withdrawing it over time, okay? So if you don't use your RSP, you have 18.66. So the benefit actually got, you see, we look at the difference between here and here. Now we're at closer to $5,000 to $6,000 of benefit. $5,333 difference. Okay? Let me just write down the difference here for you guys. So 16K minus 12,665. So 3 benefit of RRSP. Difference. And here I'm gonna also calculate this. So 5,000. So this is more money in your pocket. So it's interesting. The conclusion is it's better to have more money to invest now because you're not paying the income tax up front, especially if you're at this higher tax bracket. Even if it means paying the higher 20% income tax, which is income tax is 20% here on this when you use the RSP versus only 10% capital gains tax, which is only 10% on the difference between this and this, because you don't need to pay capital gains on the cost of the stock. Okay. So this is the reasoning. Paying more taxes later, 20% versus 10% is okay, because there's more investment growing now. It's more important to have more money to invest now. And this is basically the time value of money. And you can Google the time value of money to understand this more. So now I'm going to just do one more example. A lot of people say, when should I use my RSP room? Well, it's best if you use it. They say it's best if you use it at a higher tax bracket. So now what I'm going to do instead is change it to a 20% tax bracket. So that's the lowest tax bracket, okay? And I'm going to use this. Sorry, let me just fix this. It's going to be the same example as this above, the triple one, except instead of 33% income tax bracket, it's 20%. So 90K again, 80K is used for, expenses. So you have 10,000 to invest. If you put that in an RSP, then you don't pay taxes on this 10K. So 14 years, it goes to 30K. And then, actually, this is exactly the same thing. So in 7 years, you have $24,000 left over. So we don't need to calculate this again. But this one is where we need to look at $90,000 income, right? If you don't use RSP, okay, let's assume less income, because at this income rate, it's going to be, okay, let me just write this. Hold on, I got to change something. Let's assume a $40,000 income. And this is also This won't change because this is still, 10K. So if you don't use RSP, income over 40,000 will be taxed at the lowest tax bracket of 20%. So 20%, that means you have 8,000 left to invest. So you see the difference here? If you use your RSP at a higher income tax bracket, you have less. There's more reason to use it when you at a higher tax bracket, because you see here you had to pay a lot of tax because you're at this higher tax bracket, and here you're at a lower tax bracket, so you pay less. Okay, so in 14 years it triples to $24,000. By the way, I'm being conservative because it doubles, right, every year, so it's quadruple. But let's just be conservative. It's okay. We just say in 14 years it triples. That's still possible. You have $8,000 left to invest, and then you have 24,000, and then capital gains at 10% of the which I calculate to be 22.4. So as you can see here, the difference at 33% tax rate, you have 18.66 left over. But at the lowest tax bracket, even if you use RSP, you have less benefit because you want to see the difference between use RSP and not using RSP. So the difference here over the life of the RSP, you only get benefits of 1.5K, right? While this one is 5,000. So let me write this difference here. So what is the conclusion? Well, this one is already well known, but I just want to give you guys a numbered example. Higher tax bracket means you should use your RSP. If you're in the lower tax bracket, this is the conclusion. There is still a benefit to using RSP because of these fundamental reasons of the time value of money, not paying taxes now, even though you're paying more taxes later. More taxes as in you're paying the 20% tax by using RSP. But if you don't use RSP, you pay less taxes later because it's only 10% because it counts as capital gain, but you still have less money. So what do I recommend? Again, talk to your tax accountant. I'm not a tax professional. I'm a real estate professional. I'm a realtor, but I'm very interested in investing and helping people keep as much of their money as possible. I would say if you have RSP contribution room, but you're at the lowest tax bracket, you could use it if you want. And actually, you should use it if you expect to not earn high income for the next little while, because you want to get that benefit now of paying less tax because of the time value of money. Google that. But let's say for some reason, I have a bunch of RSP contribution room, but I expect myself to, make higher income in the near future. Then I might save the RSP contribution room because it can be carried over. I might save it for the future years because there's more benefit. But then it's not very clear, because what if you get this high income in 5 years and you save up all the RSP contribution room? When you save up RSP contribution room, you are not getting any benefit at all. So there's still a case where, I know in 5 years I'm going to make over 100,000, for example, but still I might just use up all my RSP contribution room to pay less taxes today. Anyways, I hope you enjoyed the video. If you have any questions, type in the comments, and I'll be happy to hear from you. If you need any real estate tips, you want to buy or sell a property in Ontario, I'll be more than happy to advise you. Great, awesome. My contact information is in the description. I'm going to post all this in the description so you can go through the math. Take care, guys, and happy investing.